Hi, this is Bill Prater, and welcome to the Builder Show, where our mission is to provide you with champions in their respective industries from all over the planet. That's so we can provide you with timely, provocative, and actionable resources that inspire, promote, and accelerate your quest for business excellence. Today, we're going to find out how balancing growth and the high cost of capital in the cannabis industry is such a tough deal. And Paul Weiss is going to walk us through that. Now, after a career in financial services, Paul entered the cannabis space as an investor in 2018 and subsequently met Paper Planes founder Carter Latimer in 2020. The two of them developed a shared vision of how to best develop and build Paper Planes into a world-class brand. And then Paul joined the company as CEO in February 2021, and he's going to tell us how that whole thing took place. So my first question, Paul, is who in the world do you guys serve?
Well, I would say first of all, Bill, before I even go into that, thanks for inviting me onto the show. I've always been a fan, and I really appreciate the opportunity. We serve the rec market in California that enjoys cannabis. I have a lot of my contemporaries that like to talk about it as medicine and all of the medicinal aspects of it. But in the end of the day, this is a very vibrant recreational market, lots of participants in it. And as big as it is, and California is a $5 billion legal market right now annually, it's growing at about a 25, 30% clip very quickly. And there's a lot of people that just enjoy using cannabis. So our company is a provider of concentrates. We make one of the premier makers of vape carts and some other dabbable concentrates, as well as hardware. And we sell our products through dispensaries here in California.
Excellent. There's a problem that you guys no doubt have identified and solved. So could you articulate what that problem is, Paul, that you and your company solve?
That's a big question from a market point of view or from an operational point of view, Bill?
Let's cover them both.
Okay, let's start with a market point of view. There was a very big gap in the market for consistent, high quality, lower priced product. And this sounds like something from business school in 1842, the most basic possible thing. But in any nascent industry, and you can probably go back to all of them, huge inefficiencies pop up because there's far more demand than supply, there's far more capital than there are places to deploy it, all the inefficiencies that take place to start the bubble concept. Cannabis was a textbook version of that. And by 2018, 2019, there was the green rush, which was basically anything that was cannabis was going to be successful. So lots of productive capital was poured into unproductive companies. And you ended up having very expensive, poor quality products that got very big. And as soon as the market matured, after 2018-ish, when it became recreationally legal, you started to separate the wheat from the chaff. And that's what really created the hole in the market, which was the consumers were getting sophisticated, the price compression was coming in, and the inefficiencies were being borne out. So our founder, Carter, really understood this and said, look, he has the SOPs, he's a foundational figure in the industry, he's been doing it for a dozen years. And our brand was known as the best brand, but really more of an avid user brand for dabbing and so forth. But his idea, which he always executed on, was if we could take a really great product and find a way to scale it properly and be reasonably priced, we're going to make a fortune. And as non-revolutionary as that sounds, it was actually rather revolutionary just 3-4 years ago. So when we met, and I was just exiting an investment and very involved in the industry and really wanted to get more involved, Carter and I spent a year talking quite deeply about this and had an opportunity to buy a facility together. And I came on as CEO. I moved out to the West Coast and started our journey together. And we're now in the top 5 concentrate brands, very quickly profitable. And that's a whole nother discussion for the other side of this question. But we found an unmet need, which is so fundamentally basic, it sounds ridiculous to say, but high quality products consistently made at a reasonable price. And I suppose we're still a bit of a standout there as we're watching other competitors of ours kind of fall away to the wayside. That's on the operational side. On the financial side, we haven't solved this problem. We certainly identified illiquidity. And I talk about it, I guess, in the last 3 or 4 quarterly updates I've sent out to our investor base. It's about illiquidity. There's almost no capital driving industry growing at a CAGR of 25%. How does it even work? It's just a symbol of how strong demand is and how much this product, like alcohol and like other vices, if you want to call them that, really are what people want and enjoy and their lifestyle and they're cool and all the rest. What we have done, and it goes back to the title of the show, is identify the illiquidity issue and attack it every day. It's not more complex than that. It comes from managing your ARs, to managing your payroll, to managing how you capitalize your company properly, how you don't put yourself in capitalization pitfalls by levering up the wrong way. All these things are day-to-day knife fight issues. And when you combine our market approach, which was to get the better product and to have it reasonably costed, and to have a business model that is lean and efficient, and realizing that if you have a great few months, happy days aren't here. They're just not. It's just going to continue to be a grind until there's more downstream opportunities for capital to flow. So those are the 2 big separate issues that I wanted to highlight.
Okay, excellent job with that. I'm glad you covered both sides. Now, this question I'm sure you've heard many times, but I'd like to know, our listeners would like to know, how you guys differentiate yourself and put your competition in the dust, so to speak.
Fortunately, we don't put all the competition to dust because some of them are really great people and make great products. Cannabis as a culture is a little different. I come from financial services where the concept of zero sum and my pile's bigger than your pile, and that's all it's about. It's a little different in cannabis, which is refreshing. Not entirely different, but a little different. In the old days, it was all kumbaya. It's not quite all kumbaya now, but we are very involved working with joint, I won't even call them joint ventures, collaborations with many of our competitors. For example, everyone knows we make the best oil, so we do a lot of tolling for many of our competitors. So you go into a dispensary and you're going to see our brand, and next to it our competitor's brand, which we get paid to fill. And everyone's happy with that arrangement. We buy feedstock from competitors. It's actually such a big market and so underserved by quality that the good companies actually band together. When I go to conferences, it's actually a joy to sit down with other people that are running companies and really not feel like I'm trying to get a step and a half ahead. I just want to do more business with them. So it's a unique way that way. Now, that being said, yes, we are a business. We're not .org, we're .com. We're a for-profit company, and we're growing at a pretty fast clip. And that comes by taking shelf space, ultimately. In order to do that, we've really focused on a few core things. And these would probably be the most important things I could share, which is managing your decision-making and inventory and your longer-term planning so you can pivot with changing consumer preferences. And the consumer preference changes, not as much regulatory, you'd be surprised. That's not the big issue. It's basically shifting to where the market wants to go, where price compression's coming into certain SKUs that you have to move away from, and staying extremely nimble. This goes back, Bill, to that efficiency issue. And if you can stay really tight. Now, there's a downside to all this. You can't scale as fast as you want if you don't build enough inventory to go 3x in 3 months, right? So you get a runaway product and you don't have product, you can't run away with it. And that's the catch-22 with where's the balance? And this goes back to the show's concept. Where is the balance between your precious capital, preserving your company, and having a runaway product that you don't have enough to sell and your vendors are pissed because you can't get them enough shipments? And that, because it's an illiquid market environment, we can't make mistakes. We can't screw up a $300,000 inventory investment. It would be really bad for us. That balance is the hardest part. Right now, we feel we've caught a beautiful wave and we're taking a bigger and bigger bet on what we're doing right now. But that came after 3 years of really fine-tuning this thing in and being part of a segment of the market that can sustain maybe a slight misstep if we have one.
So you mentioned the $5 billion market. Is that the retail size, or is that all in, or what is that $5 billion market
It's about
consist?
four to, yeah, it's a $400 to $500 million. I'm sorry, I cut you off, Bill. It's about a four
That's
to $500 million market monthly, and that would be legal sales at the retail value through shops. It's a much bigger market if you want to include black market, which we do not participate in at any level. So that market's been growing at a pretty crisp CAGR, I'd say 20 to 25% a year, maybe a little less in the last couple of years for different reasons. COVID had a big bump. Everybody was sitting home using THC. And then after that, a bit of a stabilization, but we seem to be getting our sea legs now. And there were some other issues that also muted the growth of the market, but it didn't go backwards. It just kind of went sideways for a year or two after a big bump. But we're seeing that growth resume in a pretty big way right now.
changing hats to being a business owner, senior executive, etc. What would you say were the major milestones of the, if you will, the growth of paper planes? And what were the lessons both of you learned along the way, either from successes, Paul, and or failures?
So the seminal moment for our brand was when Carter and I came together, and we had collectively a ton of scar tissue on our body already. So we came into our relationship 3 years ago with a lot of understanding of what we wanted to accomplish and what we wanted to avoid. And the number one thing that we understood was, I have a sphere and an area that I'm very competent in, which is corporate governance, administration, capitalization, typical executive functions. Carter had a sphere that was incredibly accomplished of understanding the market, understanding consumer, understanding process, master extractor, master grower, all the things. And each of us knew maybe a tiny bit about the other side, but enough to maybe blow our feet off. So we developed a concentric circle relationship where we had just a touch of overlap, where we trust each other and we work with each other. But at the same time, if one of us is passionate about a decision, that's the end of that decision, because that passion must be right in your area. That was the fundamental difference between us and other companies, gosh, I won't, but I could name them, that achieved success and then found it fraying apart because, you know, it's easy to say egos, but there's also strategic vision differences that are beyond ego and ego. And you see really dumb decision making after the hill's been climbed. Carter and I are like at that point now where the company's truly breaking out into consistent profitability and a strong rate of growth. And I can say that we're maybe more neurotically fearful of making mistakes now than we were at the beginning. We're just so careful about it. How do we allocate money and so forth? So to answer your question, it's understanding your lane as an executive, understanding the strengths of your team and playing around them. We understood that. We took a year to know each other before we started this thing. And I like to say that trust is the coin of the realm here in this industry, and maybe less so for guys like me that, as they say, parachute in, but it's very hard to get the trust of legacy people that came out of a market that was handshake and was based on only trust in your word. And I accomplished that, and I try to earn that every day. And those are the secret components that I think have made this relationship work and the company successful.
Excellent. In addition to the two of you, how did you go about building the rest of your management team? Maybe even recognize some of their accomplishments, where they were, how you found them.
We have a very tight core team. Our executive committee, or our management committee, we call it both, is 4 of us. I work with someone named Laura Trossel, who's just, I'll speak about her in a moment, just outstanding. And Carter works very closely with his dear friend and partner of ours, Clint Okada. And what we did was divide responsibilities very carefully, where Clint will look over the operations of the facility. Carter looks over all of the areas to make sure that the strategy's right, sales are right, and so forth. And Laura and I work on the admin side. We also recently acquired a company that has several farms, and the guy running that's a guy named Christian Andreasen. And Christian is a master grower, a dear friend of Carter's for many years. And that team of 5 people, 4 of us that run the company, I include Christian because he's so important with regards to his understanding of genetics, which drive a lot of the quality of our product and so forth. It's an impenetrable group. We don't have a for hire sign outside. We're very careful that we don't let any snakes into the tent and so forth. I will tell you, that being said, there's a lot of rotation at junior management and a lot of rotation definitely at the most junior levels. We have a couple of excellent mid-level managers that are doing a great job in our lab and so forth and up at the farms. But there's a lot of rotation at the very bottom end. And we've just accepted that it's an industry that attracts people that think it's cool. And it is cool, but when they get into it, it's a job and it's tough and it's a grind and it's the same pressures. We've built a very tight team at the senior levels. We've had no attrition and I see none coming. We are tight as can be. And I think that's really important because there's a lot of heartbreak in this industry and a lot of tough moments and a lot of moments where you kick yourself in the backside because of the dumb mistakes you've made. I have 4 of those a day. And you need a team around you that you can be vulnerable with and also ask for help with, and no one has anything other than an interest in seeing the company move forward. I may have strayed away from your core question, but I just can't say enough about the importance of having a solid management team that you trust and care about.
You mentioned getting, letting people in, if you will, into the tent. Do you have some core values, Paul, in the organization that to help you in that endeavor?
That's an interesting question. I haven't been asked it that way. I'm going to free associate a bit because I haven't really thought about that question. That's a really interesting one, Bill. I'd say the number one value is check your ego in at the door. I like to say at all our management meetings, let me start out with the dumb decisions I've made in the last week and help me unwind them. Or we're all very secure in our positions and our jobs. And there's not a whole lot of sense of what I saw on Wall Street, which was climbing over the dead bodies to get to the top. It's just not part of this company as we have it. So that would be a core value. I'd call it selflessness or team building, if you want to maybe mish those into one thing. Yeah, I think I would stay with that as the number one thing. The other thing is that none of us are scared of hard work. Going back to Laura, she did not come from the finance or the administration side. She really came up through all the aspects of the industry, which would have been really touching everything from growing to, she's master extractor to dispensaries, and putting people like that in a senior management position that don't necessarily have the Wharton CV and all the rest. You can always import that talent. People that know the industry, have a passion for the plant and get it, and are here because they actually wanted to be here. That's what our management team is. I really wanted this. Carter always really wanted this. And the rest of the team are the same way. So I don't know. I'm not sure that would qualify as a value, but it's a quality.
It sounds like a value to me. Absolutely. I think maybe most all of our listeners, Paul, don't understand the complexities of finance and banking and so forth that go on inside your industry. Could you touch on that area and what lessons you've learned from trying to create a, if you will, a robust, if you will, let's simplify it and say cash flow situation in the company?
Yeah, getting your ball across the line, utilizing the tools that you have in this industry is a bit like smashing your head against a cheese grater. It's really a challenge. There's very few quality counterparties, particularly when you're starting. You really just can't open a cannabis bank account and lock and load. You can't get an accountant of any quality to look at you and do work for you on a timely basis or a reasonable basis. The lawyers that you're talking to are going to be either vastly too expensive if they're the top firms, or are going to be somewhat underqualified if they're the lower. So there's so many structural impediments to getting up and going. When we started this, I made sure that we raised more capital than we needed. I thought at the time it ended up being a fraction of what we needed times 10. But I thought we were well capitalized. At least we had a big bank account. And I made sure that within the first 12 months of our operations during 2021, when I say the first 12 months, when we re-entered the market with capital and with structure, my priorities were quality counterparties, making sure we had best-in-class lawyers, best-in-class third-party accountants, bookkeeping, everything I could to demonstrate to the world and our investors that we were not a bunch of yahoos that came out of the hills and were selling hash. We were really a very serious company making a consumer product that had corporate discipline and would be far from bank ready, because that's a hard place to get, but certainly disciplined enough where our financial reports have integrity and so forth. Financial services, specifically going to banking, incredibly difficult environment. It is getting better quite rapidly. A lot of players have entered the space in the last 12 to 24 months. But about 4 years ago, 5 years ago, you had a few credit unions that, had come out of the sticks, realized there was a huge unmet need, and opened the doors to cannabis banking with a small compliance staff to service it. And it was just a disaster. But nevertheless, we started with it. You can't have a cannabis business in the white market being serviced by a federal bank like Chase or Wells Fargo because A, it's illegal. But even so, you don't go to jail for it, you don't get arrested for it, but they shut your account for it. And they used to call it playing whack-a-mole with all of your different bank accounts. And we never had to do that. We started out we have corporate banking for non-cannabis banking that's unrelated to anything we do at our parent company level. But for cannabis banking, we always had a cannabis bank. And quite recently, we shifted. I'll give a shout out to them, to East West Bank. They're doing a great job. They seem to be approaching this like a large institution should, as opposed to a small institution that's strapped on a few other items and offered a service. So that changed in the last 8 months or so. It's been a real upgrade for us. But prior to that, it wasn't there. And you really can't get into their system unless you're established, have balances, and have a background. So new companies have another barrier to entry to even get into that. Yet there are other companies in this. I'll list a couple, Dama Financial and others, that have put this front-end tech system in front of the cannabis compliance and then basically outsourced custodial and banking services to other vendors across the country that are credit unions. We've had a mixed experience with that. I'm being generous. We did that for a little while, and it's still not ready for prime time. Maybe it's getting better, but it's one of those structural impediments that makes dealing with this industry so difficult. So to wrap it all in a wrapper here, when you have difficulty getting good legal, which is a lot of different kinds of advice, when you have difficulty getting good accounting done for you on a timely basis, and difficult banking, it's really crazy. So the first thing a company has to do is focus on those core governance issues. And as good as I think we are, we still every now and then find ourselves with an oh my gosh moment. We have to pivot. But we've got this thing pretty settled right now.
Okay, that's excellent to hear. Now, I hate to grind on the same topic a little bit, but tell us a bit about challenges with payables and receivables that your particular industry / company might typically face that other people in different industries may not face.
We may run over, Bill, on time. That's a tough one. This industry makes good players look like bad players because you're involved in a circular chain that you really can't escape. So if I have payables owed to me, and I'm always good about making payables out to others, if I'm not in a raising capital environment where I'm just going to sock some equity away, I am at the whim of my own ARs. And that's a very slippery place because it's not just from our dispensary partners, and I could talk about that in a moment. I'll get back to that. But it's also if we do tolling or other types of collaborative work with other companies, and then they have a problem collecting or they have a problem financially and they can't pay us. And then we're forced to not pay other vendors. And then suddenly we go from COD to net 15 to net 30 to net 60 to we're going to work this out and get plans. Then they can't make their growth plans, and that seems to affect us. So the only way to get through that is to be diluting yourself through equity raises. Debt in and of itself is a dangerous thing in this business. It's first hard to get. The cost of debt is astronomical in this business. And it's not just the coupon, there's other strings attached, as well as covenants attached to it that make it very difficult. You almost have to accept that if we're doing accrual accounting on our revenues, our sales look great, but our collections are not so great. So how are we going to deal with that gap? And there is always a gap. And that gap has to be filled by bringing in investor capital until you're probably 50% further along on your break even than you need to be. So far ahead that you're no longer just counting on that line. It's not a matter of you make more revenues than expenses. It's you make more revenues than expenses and you add a whole buffer for your AR and collectible issues. So what frustrates me the most of what I just shared with you is that we look like bad actors to some, but we're being held hostage by others. And that is the nature of an illiquid environment, and that is what cannabis is. So we try to explain that, and the smart counterparties know it, and they work with us. And quite frankly, all of us are looking to that moment where all of this comes together and there's some more grease for the machine. But right now, it is a challenge. And even if you're one of the largest companies, and there's many of them, these big MSOs that are in the hundreds of millions of dollars now, they're having issues. I won't mention, but one of the largest dispensary chains ended up being 180 days behind on our invoices. And we did those deals for net 30. And you're like, wait a second, they're in like many states, they're huge in California, and they're not paying us. And the crazy part is the larger companies that they do business with have invoices that they can cancel against. So they don't really have the same problem. You buy from me, I buy from you, we cancel out, no cash changes hands. But when you're actually selling product to get paid, they hold back their terms, they strangle the smaller companies. And this is a real big issue for us and a lot of other companies. So that adds to the illiquidity. So to kind of circle, actually, one more chain I'll mention, they just went, this is a really good chain, they just went from net 30 to net 60 days. And our product sell-through is 30 days. So we know that they've collected, they've done their job, and they do it for one reason, because they can. We're interest-free financing for them. And it's punishing. So the only way out of this, there's two ways, is to grow your way out of it where you just don't care. And there are some larger brands that they just don't care anymore. They're so large they can do it, or raise capital through it, which is its own enormous challenge. That balance of all these things, at least being aware of them, so when they hit you, you're not thinking to yourself, oh, this is terrible, woe is me, I hate this environment. This is the environment. And if you want the big exit and you want to grow your company properly, you really have to accept that this is just a very difficult operational environment to be in.
Excellent. Great answer. Thank you very much. Looking into the future, 5 years, 10 years, what do you see as the competitive landscape in your industry? And what do you think the industry will mature into in that period of time?
I could make something up, but I don't think I could see past the next year or two, maybe 3. Realistically, it would be like in 1999 asking Steve Case at AOL, so where's the industry going? And he would tell you about how AOL is going to dominate. And we don't know what happened. It really is that nascent, and we have such an upward trend. The industry is at some point going to be national. Years from now, that's going to be a seismic change. The Safe Banking Act going through along with rescheduling is going to also make very big changes with high quality implications and a lot of unintended negative consequences. And we just don't know what those are going to be. But I'll take a shot at this. I think that the industry is going to more and more be commoditized. And the only difference between one company and another is the quality of their brands and the consistency of the product they offer. Sound familiar? That's what we do. And we do believe that is the only difference, because at the end of the day, people, their sophisticated palate will develop more and more. The market will want, just like with good wines or just like with any other type of product that consumers use to feel good, they want to have something inexpensive that they trust, that's cool, that tastes right, and all those things, just like your favorite bottle of Pinot Noir that you may get a case after case because you just like it. I see the industry rationalizing towards that. So what does that mean? I think it's going to be obviously a lot of consolidation. There's going to be several very large companies that are brand heavy in the best brands and then brand heavy in the Budweiser brands. There's room for both, obviously. But you're going to hear that word brands. So why have I committed my life to this company? Because it's a brand, it's a great brand. And I think that going out 3 years or 4 years, it's all that will matter to distinguish you from another company. And if you're legacy, you really have a huge advantage because you don't have to invent your pedigree. It's actually real and it's actually cool. Many good legacy brands are going to fade away because they mismanaged their path and their journey. But if we can stay on this path. I think that it dovetails very neatly into where I see the industry going, which is 5 or 7 very large companies that have national brands that they are very comfortable with, and a consolidation towards that end with streamlined financing and access to capital markets, which will certainly come in 3 to 5 years, but I wouldn't say a day before then.
Okay, excellent. So what's holding you back right now, do you think, here in early 2024 as a
Money,
company?
money.
Okay,
It's just very difficult to do good deals for the company. Debt's very hard to deal with, not only for a company our size. So take a company that's going to do $10 million and make a few $1,000,000. You've really got to have the governance in place that is probably a little bit ahead of where your structure can afford to be, which makes sense. Institutional funding is one thing. This is an industry notorious for knuckleheads. So these lenders are aware of that and they're very careful. Plus, the rates, let's talk about the rates. You can get a company doing several tens of millions in revenue, making a healthy profit. They're still going to be in the low to mid teens on the coupon. There'll be warrants attached to the size of the debt, and there'll be covenants that are heavily restrictive. And it's going to be securitized maybe 1.5, 2x against your assets. This is almost like Tony Soprano stuff. And it's very difficult to do it, but that's what the industry is doing. And there's a good reason for it, because a lot of these big companies took in a lot of capital, destroyed hundreds of millions of dollars of productive capital over the last few years. And that sting is still with all the major providers of liquidity, such that they're still providers of liquidity. So that capitalization issue and how it's managed is a critical component.
we've got a variety of people listening to you right now, Paul, potential customers, vendors, suppliers, investors, financiers, etc. Maybe there's one path, but what's the best way for various people to get a hold of you?
Oh, first check out the company, paperplanes-ca.com. It's our website. And we're also, I'm not supposed to say this, but on Instagram, paperplanes.extracts. You could follow us there. If somebody would like to email me directly, it's PW, my name, Paul Weiss, PW at paperplanes-ca.com. And love to hear from people. We are very open to talking to people about our company and how we're doing what we're doing.
Excellent. I've asked you a few questions, but probably, or maybe there's a question, Paul, you're thinking, gee, wonder why Bill isn't asking me such and such a question. If there is a question like that, what is it, Paul? And then what is the answer to that unasked question?
You did ask a lot of good questions. One of the questions that I field a lot, and I'll probably be speaking about at a conference, is what's going to change the liquidity environment and improve it? And that to me is a very important issue because, look, I'm not an industry spokesperson, but I'm an advocate for the growth of the industry. And this industry will suffocate and become very boring and not as successful as it could be if you elbow out the smaller and mid-size part of the market, the middle market particularly. And the way that private equity and venture, particularly private equity, such that it is, exists in this industry is completely having been abandoned the middle market. There is no downstream capital coming in. So there really needs to be some mitigation through regulatory easing and having the system within California more rationalized. I'm speaking about California specifically, to make these funders once again get more comfortable taking reasonable risk, because it's become an enormously risk-averse environment. What I hear is we don't want to do plant touching in California. You have to have this, you have to have that. And they're describing this company that doesn't exist that they want to fund. And I think ultimately a lot of these PE companies have become large mutual fund investors. They're basically going for large MSOs that are going riskless. They diversify the risk, and they may get their 30%, 25% growth in normal environment, which is fantastic if you're running a PE firm at a 2 and 20 and you want to get paid. But I absolutely think that the industry needs to find incentives and needs to have some methodology of getting downstream capital coming from investor-based companies like PE and venture. And I don't know exactly how that's accomplished, except maybe by exposing them to more companies like ours, and that we're not all idiots, we're not all going to fail you, we're not all going to lose you money, and we're not all lying. And that's the underlying tone that you get when you talk to these people at conferences and private conversations. What is it that will mitigate it? More companies like ours that take governance seriously, that communicate intelligently, that don't show sort of self-abusing behavior as they achieve success.
Beautiful. Great question. And I love the answer. And I think you're onto it. What little I do know about your industry, and actually I know more than most people might. Paul, thanks very much for joining us today. Thanks for your candor, for your wisdom, and for your foresight. Appreciate it very much.
Bill, it's been a pleasure. Thank you so much for inviting me, and I appreciate the opportunity.
You're very welcome. Now, everybody, look, let's focus on the single fact that businesses don't become extraordinary in a single moment. Instead, they get there as a result of what Paul just told us. One, the owner having a strategic vision for the future. Number two, having a system of management to execute on that strategy. And number three, leveraging high performance teams. Now, you can get your hands on how to do just that. Just go to my free resource on YouTube called Business Mastery Pro. Thanks for listening, Paul. Once again, thanks for spending your time with us today.